Good afternoon. Today I wanted to share a few insights on loss aversion and its impact to long-term investors. Recently, the S&P 500 index reached new all-time highs and broke above 5,000, less than 3 years since it first crossed 4,000. While this is positive news and investors should continue to focus on those long-term goals that they have, it's also the time to look at managing risk and staying diversified. Market volatility is inevitable, and how we react to those swings is just as much, well, it matters just as much as how we position ourselves for that long-term growth. So in the next few minutes, I'm going to cover a few key principles on understanding investment returns, loss aversion, and why it matters to long-term investors. This first chart shows the break-even returns needed to recoup a certain loss. So for example, let's look at the 10% loss column, the second one from the left. If you were to lose 10%, it's going to take you 11% to get back to even. For some, this may seem odd, but this is just how percentages are calculated. If you look at that 50% loss bar, right, let's take a look at this third one in from the left. If you have, let's say, $100 and you lose 50%, you're down to $50. So in order to go from 50 back to 100, you would have to make $50 on $50, which is a 100% return. So a 50% loss requires a 100% return to get back to even. The problem is that investors typically find it extremely daunting to know, hey, I've got to gain 43% after a 30% loss. That's very difficult to stomach and to handle, which is why loss aversion is so critical. That's why we say in the markets all the time that the stock market takes the elevator down and the stairs back up, right? It's always down really quick and always make it back slower than how you lost it. But it's in these moments, it's absolutely critical to remember that the market has always rebounded. The second thing I wanted to share with you is the concept called loss aversion. And this is the idea that losses feel worse than equivalent gains. So the example is if you found $20 on the ground, you would probably be quite happy. But if you drop $20 from your wallet, or even if it was stolen from you, you might feel considerably worse, right? Even though the 20 was the same, it feels way worse to lose it than it does good to gain it. This gap between how gains and losses feels grow as the amount increases. In the extreme, investors may even give up on investing when they hit large enough losses, which we know in hindsight is always the worst case scenario to sell when those losses come. If you look at 2008, 2020, so on, there's plenty of examples. It's important to stay diversified, to have a little bit of a more smooth ride. The chart below shows that while all stock portfolios would have generated the very best returns, very few investors have the stomach for the level of swings that portfolio can experience. Instead, if you have a properly diversified portfolio, it means long-run returns can still support your financial needs and achieve your financial goals while not causing you to overreact to short-term events. This chart down here shows, starting from zero in 2007, 2008 drawdown, everyone was losing money. Obviously, lower risk portfolios or more diversified portfolios didn't lose it as fast. Okay, the market bottoms in March of 2009 and starts to recover. If you look at October 2011, a 60% stock, 40% bond portfolio fully recovers. Okay, that 100% stock portfolio doesn't actually recover until 13 months later in November of 2012. So you're having to grind it out in another entire year before you get back to even if you were taking more risk because you had larger losses. The even more important factor here is because the 60-40 portfolio didn't lose as much, recovered faster, it had a head start. And although those all stock returns ended up being far superior, the all stock portfolio did not catch that 60% stock portfolio until that last dotted line in November of 2016. So it's important to remember, what sort of losses do I want to see? How long do I want to wait for recoveries to happen? And does your plan need this high, heavy stock allocation associated to it? The last thing I wanted to share is what's called the sequence of return risk, which is simply whether investors experience good or bad returns first. Now, this is specifically for folks nearing retirement or in retirement, and this is when it's most critical. So if we drop down to the chart and we look at the dotted blue line, this shows you have $100,000, you don't withdraw any money, okay, and your money grows over time, and towards the end you experience a bear market, right? You get up to about 800 grand and you fall to around 500,000. Now, the dotted orange line or yellow line shows, what if I get that bear market first, right? So I had 100,000, I lost money first, but I did end up getting the same average annual return as the dotted blue line. You can see you end up in the same spot. The key is, this is the folks that are not withdrawing money out of their portfolio. If we go to the solid lines, think retirement spending, this is when this is most critical. If you look at that solid blue line, this shows retiring with $100,000, withdrawing 5% a year or $5,000. If you again get the bear market at the end, you're going to be okay, right? You start with 100, you're withdrawing a little bit, okay? So it doesn't grow as fast as the dotted line because they're not withdrawing at all. So it's still growing, just not as fast. And then towards the tail end of, in this case, most likely your life, right? You get that bear market, your money starts to fall, but you're at the tail end of your life and it's not going to fall fast enough. And now you were able to get up to 300,000. So the losses at that time don't have as big of effect. Now, the solid yellow line is the sequence of return risk. Okay, it's in what order do I get those returns? If I get them towards the end, I'm going to be okay. But what happens if I get them early? And you can see, start with 100,000, withdrawing that 5% a year, but I go through that bear market early in my retirement. Boom, I fall well below 100,000, and I still have to withdraw my 5% or my $5,000 because I have to live. And now there's not enough money in there with your withdrawals to recover at all, and it ends up a slippery slope down through your life. So this is why sequence of return risk and protecting that early portion of your retirement is so important, and why we spend so much time with our clients in or nearing retirement building these 5-year income plans to be protected from sequence of return risk. So lastly, thanks so much for watching. Please reach out if you have any specific questions or comments. If there are any specific topics you'd like us to cover, please comment below or shoot us a message, and we'll do our very best to cover them. We hope you all have a great rest of your week, and we'll talk to you all very soon.